I don't know how long I'll be able to last, but we'll see. I already done my morning lecture. All right. See, I was pretty much down for the count. I couldn't do any lectures or anything. So this week I'm gonna basically lecture on chapter 7 myself. We're not gonna have Jeopardy. Next week we're gonna do chapter 8, and you'll have your quizzes this weekend, and we'll do Jeopardy next Wednesday on chapter 8. But this chapter is actually a little bit better for lecturing. Come on, work with me. Basically, it's about market efficiency. It's somewhat of an elusive concept, both in terms of definition and also in terms of being able to test it. It basically says, in most generic version, the so-called efficient market hypothesis. It says, given available information, no one should be able to make abnormal returns. Now, that definition alone creates a few questions. One, what is an abnormal return? So we need to figure out some way of defining it. Plus, uh, what is the given available information? So if you're going to actually look at three different versions of the efficient market hypothesis, the first one is the strong form of efficiency. You should not be able to make abnormal returns on a consistent basis. I mean, in a given year, you could have abnormal returns just out of luck. On a consistent basis, uh, given all available information, public or private. So if the markets are strong form efficient, even as an insider in a firm, you know stuff that the rest of the people do not know. You should not be able to make extra money. So if you know that next quarter you're going to announce earnings that is well above what people are expecting, that information should not help you at all. I mean, that doesn't mean that quarter it won't help you, but if you follow that strategy, knowing what the earnings are going to be 2 weeks ahead of time, that shouldn't help you make extra returns on a consistent basis. This is probably more likely to be violated because, if I know that they're going to announce earnings that are really going to be high, uh, I could probably make money off of it. In fact, There is some evidence this is more likely violated as insider trades. Again, this doesn't have to be illegal. Tends to make more money than rest of the trades. Companies are required to report trades by insiders. Okay, I think it's called an 8K form. They can check if you go to SEC. Let's go to sec.gov. And for example, let's look at NVIDIA. Search filings. Yeah, let's try it again. Okay. These are the 8K reports. These are earnings release, but um, ownership disclosures. Yeah. Here's an example. Let me see. This guy, name of the guy is Puri AJ. He's executive vice president in charge of worldwide field ops. What did he do? He disposed securities, you know, 12,500, that's 150, 151. These are things that are at the pretty much beginning of the year. And he kind of did it in an indirect way. So we know what kind of trades they do. Uh, there are studies that looks up these trades and they see that they do better. In fact, one of the uh, more convincing evidence, we used to have a guy over here who actually did a paper on this. You know that a lot of these executives have stock options, right? And once these stock options are vested, it is up to the executive when to exercise them. Turns out a lot of times these executives exercise these options a few weeks or months before the next earnings announcement because they know, we don't know, but they know approximately what the earnings announcement is going to be. And if it's higher than what the market expects, you know, if market expects that earnings are going to be $2 a share, but you announce 240, that stock is going to jump. So they exercise it before the earnings announcement. And when the earnings are announced and stock jumps, you know, they sell those stocks that they bought when they exercise the options. So having insider information actually helps you. But that should not kind of discourage us from thinking that markets are efficient because this is information rest of the market doesn't have. If rest of the market knew that earnings were going to be higher, obviously they would have traded to that effect. So if that's the case, nobody would have been able to make money. So that's the strong form. And that is the next one is called the semi-strong form. This says you should not be able to earn abnormal returns on a consistent basis using all public information. This means there is no point to trading using fundamental analysis or technical analysis, because fundamental analysis is made using publicly available, things like financial statements, any notes about them, or past price and volume behavior. So if markets are semi-strong form efficient, there's no point doing trades using fundamental analysis or technical analysis. There is some evidence in favor of this. We have mutual funds that are actively managing the funds, right? They're not just passive. They're not just buying an index and holding it. Either they time going into and out of the index funds or asset classes, or they actually select specific securities in each asset class and try to make more money off of it. Well, if markets are not semi-strong form efficient, we should be able to find some mutual funds that are beating the markets on a consistent basis. Unfortunately, that is not the case. I don't have the exact statistics now, but on a given year, typically 80% of actively managed mutual funds